Bear with me a second. That should be better now. Yeah, I got my proper microphone on now. So, good afternoon, good evening, good morning, wherever you are in the world. It's our 2026 review, our outlook, I should say. We did the review of 2025 yesterday. As far as the marks are concerned, I'm starting with the chart I left you with yesterday. Probably the chart of the year, the weekly chart for silver. Absolute phenomenal run. It's had parabolic run, as we were saying yesterday. Parabolics. I hate looking at parabolics, and as you can see on even this is the weekly chart because yesterday's huge. So we've got the daily. Flick back to the daily. Massive engulfing, lack of liquidity. It looked like the actual COMEX side of things, the actual bullion side of things, the actual real live silver traders are still lapping it up. It was to do with the futures market and the sort of the paper market, basically the derivative markets that freaked everyone out yesterday. But a big bounce back today, as you can see in the daily chart. But the demand is clearly there. The fundamentals we talked about yesterday are still around. Still some significant buying. This idea that this AI boom is gobbling up commodities, copper, platinum, silver, gold, all getting receiving the bid. And as I quoted yesterday, somebody I'd seen on, you probably saw him as well yourself on Bloomberg yesterday. Digital eats physical, so the physical resources like silver and gold getting bid on the demand side from the markets, but also there's this huge central bank and government buying of these assets as well, particularly gold and silver for reserves. So where do we go from here is obviously the next question. That's what we're going to cover today in the markets. What do we look like? What's the main fundamental outlooks? How is the market going to react to that for the next 12 months? Obviously, predicting what's going to happen in market is a fool's game. Obviously, the professionals on Wall Street and in London, Tokyo, and the other major trading centers of the world have to do it. It's the nature of their job. But it is a bit of a finger in the air job, isn't it? And we can. I do it as well, just as a matter of bit of fun, to be honest. But technically, we can set our levels to the upside and to the downside of where we are at the moment. But as with every market, price determines everything. And that candle pattern, again, as a candle pattern trader, that's a significant engulfing candle just yesterday. But there were some significant issues around what happened yesterday. They normally are when we get big candles. So what explains it? Well, it's obviously to do with the parabolic nature of that move up higher and the structural changes in the silver market, and in particular, as well as the wider commodity market, as we've seen this demand increase. So there's somebody actually in the chat box. So let me just check that. IG Evo FX is saying hello. Let's see gold, dollar. Certainly, we'll come to gold in a minute. So there's silver. As I said yesterday, the chart of the the chart of the year, really 180% up. When I did the maths, when we went to $80 the other day. Obviously, by the end of the year, we'll see how that calibrates. Obviously, some markets are closed already in Asia tomorrow. So, but we'll do an actual gain for the year. But it's 100 and odd percent. It's 150, 60, 70% at least on the silver market year to date. So it's a big boost. Everyone's favorite trading asset, though, it remains gold, and gold had a similar shakeout yesterday. Over similar issues due to the lack of liquidity. This tends to happen at these times of the year when there's not much around. It's an end of year, end of month, end of quarter. All of those sort of things still come into account, remember. And so huge sell-off yesterday on gold, as well as we'd gone over 4,500 yesterday and earlier in the week. And we're currently trading at 4,386 here on the daily chart. We just go up to the weekly chart still. We can see this final week of the year. Again, I'm running my December account into Friday, so 2nd of January will be the close of my 2025 account. I've got three. I'm not taking any more new trades actually. Those of you that are interested, I'm sure nobody is. But I've got three index trades open at the moment. I'm currently long the DAX, the S&P, and the Nasdaq. They're all currently just about in the money, and I will probably close them out just from an accounting point of view on Friday. Just start clean. I'm not taking any more signals. I'm not giving out any more signals before the year end. But as you can see here with gold over the last, as we said yesterday, massive increase in volatility this year compared to the last few years. Picked up a bit last year, as we talked about yesterday. Huge rally in this second half of 2025. Where does 2026 take us? And that's what we're going to talk about today. Well, the fundamentals are still there. There's still a big worry about the debt, particularly in the developed markets. We talk about, I talk about this throughout the year sporadically, but typically at this time of the year, the debt in the developed markets is absolutely massive. When I say the developed markets, that means the big industrialized countries, particularly the US, Japan, Europe, Germany, UK. The debt that governments have got is huge, and that has weighed on safe havens like the Swiss franc. Like the yen, which hasn't been, obviously there's been other factors pushing the yen in the opposite direction. The yields again went parabolic today as the markets closed. Huge move for yields and treasuries in JGBs in Japan. But so that sort of pushes demand for gold. There's been these fundamental structural changes in the gold market as well. There's obviously the global conflicts continue to weigh on that. Russia, China, big buyers of commodities and gold. The other, buyers are major governments around the world. And that's been the big structural change. And then we've seen what's happened this year in particular has been the developing markets, the emerging markets. They're flexing their muscles away from the dollar. The argument or the story around the dollar dominance started to slip. We haven't really seen that. That story won't go away. And as I said yesterday, in my personal opinion, for whatever it's worth, I can't, in my trading career, however long I'm going to keep going, perhaps not as long as Warren Buffett, but in my trading career, I'm not expecting the dollar to lose its dominance in the marketplaces. I mean, it might come in a few years. I don't know. China, eventually overtakes them as an economic powerhouse, which they probably will see, just on sheer numbers, in sheer number terms. That will probably happen, certainly in my lifetime. But as far as the dollar dominance story, it'll still keep coming around. But that's been driving part of the argument for gold as well. Obviously, the issue around treasuries and the yields going up, particularly, as I said, in Japan. The drive for gold then going into next year is still there. All the things that have driven gold this year. Hello. My screen just went off. I don't know if you can see that. There we are. We're back. The things that have driven gold this year, those fundamentals remain the same. The downside risks for this, obviously, quite significant move, less parabolic than we've seen in the silver, but it's still a very significant, obviously, huge rise since the summer for gold from 3,300, 3,500 zone that we were in. To 4,500 now. The downside to that is a rapid surprises that the market hasn't priced in. So we might not get the dovish Fed that the market is expecting. We are expecting at least 2 rate cuts next year from the Fed, possibly more. The risk is probably more to come if we get a more compliant, that's perhaps the wrong word, but somebody that's much more in tune with what will take more pressure from the president, assuming the mantra doesn't change, because the key thing from this year has obviously been the unpredictability of the president's announcements, Trump's announcements. We obviously saw that big shift on markets on April the 7th, that week, April the 7th, October the 10th, over the Nobel Peace Prize that shifted markets, and talk about tariffs against China in particular around then. And obviously, markets again are expecting a bit more of a sort of a pally rapprochement, sort of opening up of arms perhaps to China in 2026. Remember, Trump is a very transactional character by his very nature. So as a politician, he still remains very transactional. He obviously, although there's chatter about them changing the constitution so he can actually stand for a third term, whether that's very unlikely to actually happen. But who knows? Let's never say never. So what sort of legacy is he wanting to leave? He's turned, in his first 12 months, he's turned, the trading world, the business trading world, not our trading world, on its head, hasn't he? With this idea about tariffs and that it's going to benefit the US economy. Well, we haven't really seen much evidence of that yet. Also, though, to be fair, we haven't really seen the spike in inflation many were expecting. The clean data that's going to start coming out following the government shutdown for best part of six weeks or so, in January and February, we'll start to, if the inflation is going to bite, it should be biting by now in the numbers. There has been some signs of goods inflation. So again, all of that adds to a bid on the gold side as well. If inflation's starting to bite, as a hedge, gold is normally a purchase, but obviously inflation hasn't really gone up. It's signs of stickiness, but that doesn't explain this rally, this significant move we've seen in the gold market. It's much more structural. It's much more significant buying of the asset. And when central banks buy bullion or buy paper gold, they don't tend to offload it very quickly. They'll hang on to it for a while, despite a collapse or potential collapse in the price. But at the moment, their asset, their balance sheets are looking very positive for their gold investments they've made during the year, clearly. And that's the same for anybody who's bought gold, whether it's jewelry, whether it's bullion, whether it's rings or whatever it is, and you've stuck it under your bed, or it's you've been paper trading the comics or the futures market as well. So gold outlook, really, from my point of view, I say, for what it's worth, it's just my comments on what I expect. It's it's bid, and if we look at the technical setup, if we come up to a different, I use a different layout because these are the ones we're just using for the view ahead. If we look at this, let's look at simple moving average on the weekly chart here for gold. And you can see, the trend is very much positive, very, very significant. This is the 20-week moving average, okay? The red line here. And, we haven't broken under it at all since October 2023. Look at this. This is the weekly. I'll say that again. This is the weekly, our crossing moving average strategy, the 20-week moving average, and we haven't been under it since the 9th of October, the week of the 9th of October 2023. So, that's telling me, well, the story is the trend is strong. If we put something like an ADX on here, which is a trend following indicator, the laggiest of all the trend following indicators, it would show a strong move up here. And you can see again, reading the charts from a candles perspective, the bigger the candles, the more significant they are. So the big candles are green candles going positive. So April the 7th, that was at the tariff first announcement. This big one here, the 13th of October, to the upside when he talked about extra tariffs on China. The move down the following week, profit taken as we got to the end of the quarter, and then we've moved higher into this final 6 weeks of the year, giving some back finally yesterday as we got to the 4,500 level. But anyway, as you can see, so going forward, that trend is set. We haven't even broke under the green line, which is a 9-week moving average. So that's been a support area. Support, under it, back over it, under it, back over it. So again, big support 4,225 technically. You see the candle patterns, this zone through here. Um, it correlates to, there's a key fib level there at 4,185, another one at 4,125. The 9 period is above that. The floor that we found here at 4,000, the psychological 4,000, we're now 12 weeks over $4,000 for gold, sits now right on the 21 EMA on the weekly chart. So some significant support levels as this goes forward. So they need to be broken one after the other if this market is going to go down. I mean, it could move down very, very quickly, obviously, but years in the market tells me never ever to predict or expect anything, but just follow what the price action is telling us. And the price action remains robust. The fundamentals remain relatively robust for the gold market. So just hang fire. If you're long, just obviously don't get your stop loss too close is what I would say. So Evo, somebody's asking about what about today. Well, let's okay, I was looking at this today. IG Evo was all about the outlook, but let me just let's look at our trading strategy. But remember, the liquidity is low at this time of the year. The major players are away from the markets, but my what you're talking about bearish. So if we look at my mean reverting strategy, which is this Bollinger Band and stochastic setup here, and you're talking about 15-minute time frame. Well, let's have a look. What's this time frame telling us? Well, the rules with this setup here, Evo, my friend, is we're looking for a cross of the stochastics, the K and the D line, the blue and the orange here, and a touch of the outside of the Bollinger Band. So what's happened here? So the first indicator is a touch of the outside of the Bollinger Band. So we got a touch there, to go short basically there at 10:30. Before we had a cross there, that was quite a significant entry. That would have been your entry, but you've been immediately stopped out there. So you've got entry at 11:30. You're sort of in the money. The target would be the first is the midpoint of the Bollinger Band initially, but that's been stopped out. We've had another touch of the outside of so that one's failed. That one there. We've had another touch of the outside of the Bollinger Band, so we're looking for a cross down again. So the blue is just about gone under there. So you would have entered there at 13.15. So this was short from 13.15. It's now 14.22. That would have been your entry here on the 15-minute time frame using this strategy. So yes, you would have been short there, the last one, and that would have been successful because that would have been your first target here. The midpoint, which is the Bollinger Band. So target one's there. This is how this strategy works. That's what you're saying, is it? So that would have been your first target there. It's then going to, so your stop loss would have been above the turn in the market. So we got in on this candle. Our initial stop loss would have been up here because it's the top of the height of the market. That's our target. So we got our target. Now the stop loss would have at least been there, the top of the candle we entered. We moved down quite significantly. Then we bounced back. And so I'll be happy now, having got target one, I'll be happy to have my stop loss now at entry. So I've taken half of my profit and I've still got half of my risk still on the market. I might have been a bit aggressive here, but it's 15 minutes. We wait for another setup and I'm still in the money. So we've gone to target one. It's reversed a bit again, and it's still above our target one, but we're in the money. That's our stop loss. That's our entry. So at the moment, yes, we're short. Whether it goes on that way, I don't know. It's been luck, but you're going against the trend because we've been trending up since last night. So this is sort of eating up. So just be aware that we've only been under the, see here on the 50-minute, we've only been under the, in the under half of the Bollinger Band for an hour there, 15 minutes there. Then we were up 40 minutes, 15 minutes, sorry, 45 minutes there, 45. That looked like we were moving down quite significantly there. This is the European Open on a very relatively quiet day. So we had a big down candle, 8 o'clock, 8:15, but it bounced back. It bought that bounce straight away. So that's gone. This strategy has gone long there. Didn't actually get long to that one, and then it got to target one. Then it's looking to go short, which we said we it failed to go short. So you can see it's biased to the upside. Oh, this move down is actually quite significant though at the moment. So, but whether it continues that way, who knows? But it doesn't matter because we've made half our profit, and we'll see what go. But for the rest of the day, who knows, Evo? So whatever, I don't know how you trade or what you use to trade, whether it's pure price action, whether it's indicators like this or not. Whatever it is, make sure that when you do lose, you lose a small amount of your account. Keep your losses small. That's the trick of trading IG Evo. I hope you're not trading with IG, but because the spreads there can be horrendous. But anyway, best of luck. Right, back to what we were supposed to be talking about today. But thank you for that input, Evo, my friend. We were using the VWAP setup, weren't we, for the predictions or the outlook, my outlook for 2026. Okay, so that's gold. It remains bullish. Silver, similar. We just had to talk about silver as well. So the commodities remain bullish for the year going ahead. Obviously, when we have these, you see here, you see the parabolic moves, you expect some sort of resistance. These low liquidity times, it's not a surprise. We got a big chop yesterday. But we've bounced today. Remember, that's the weekly candle. We're only 2 days into the week, aren't we? Or a day and a half into the week at the moment. So they remain quite positive. So let's just go back to the top. So Bitcoin, we were at our Bitcoin chart yesterday, and we were looking at this long uptrend line from when our chart started here on trend signal back only back in 2023. So the trend is up, and we've got the channel here, and we were talking about the relative volatility for 2025. We're seeing with Bitcoin that 50,000 range from 125,000 all-time high in September and October, down to 75, or from 75,000 low in that week of April when we had the tariff chatter. So quite a significant range, and we're sat halfway between those two is the psychological $100,000. What's happened in the last 6 or 8 weeks is we've got this decline, and now we've got this consolidation. The volumes are tapered off quite a bit in December as we've gone down. Chatter on all the press, I'm sure you've seen it, those of you that trade Bitcoin, is some big whales are sat at the side. There was that big options expiry on the futures market for the institutions on December 26th. That didn't move the market as many were potentially expecting. So the big buyers may be waiting still. So they're still keeping their powder dry potentially. And as we saw on our daily chart that we trade, there may be some buying coming on. However, what could we see? What's in store for 2026 for crypto and Bitcoin? Well, again, technically here, if we again just flip to a different setup, go back to the crossing moving average strategy. One of my key indicators is this red line, this 21 EMA, and here up on the weekly time frame, we are now some 8-9 weeks under this 21 area. So we held the key 107 area for about a month or so, but the end of October, beginning of November, we've declined quite significant, or very significantly. So from this end of October, 1, 2, 3, 4 candles, big significant decline for 4 or 5 weeks, and then we've had this consolidation for the last 4 or 5 weeks as well. So significant buys at 80,000 and then 74,000 to the downside. So as we go into go back to my a little different layer, stochastic layout. There we are. As we go back to the as we move into 2026 here on the daily chart, you can see these buys potentially here at 85,000. That this big move down to 80,000, then the significant 75,000 zones. Those are the areas we were talking about on a daily basis, but they're as relevant to the weekly time frame as well. If we bring this up to the weekly time frame, see these daily spikes down, and the weekly channel is here a little bit higher here. It's at around about 80,000, but the 92,000 is key for the weekly channel, and the 100,000 and then 110, 112 area. So as we go up the time frames into 2026, obviously anything's possible, certainly with Bitcoin. But if we go back to that other chart, go back to you can see the VWAP on the weekly. You can still really see, yes, we're below the big longer term trend line, and we have been since this big shakeout from the beginning of November. But we're not that far away from it. So the trend still really, obviously over the longer time, the big holders of Bitcoin still believe in it. So these declines, these shakeouts are sort of expected, but with an asset that's got very controlled supply and demand that can be voracious, the pressure to the upside remains. So I remain relatively bullish Bitcoin. Waiting, there could be further declines into 75,000 and below, because you can see it was a big cluster here during 2024 where we went sideways through sort of 65,000. But 75, I think, could be a significant support area. We may see it before then. It may be this 80,000 level we saw. So I remain, again, it's just my own personal view, I remain relatively bullish crypto. The stable coin story from a regulation point of view, from a benign administration in the United States, is it's still relatively positive. Interestingly, though, it has gone relatively quiet with regards to the comments from around the crypto business out of the administration. But don't be surprised if we see some significant announcements and developments which will be beneficial in the longer run for the crypto market from the administration in 2026. So again, all of that taken into account. Technically, we are a week from the market is weak technically from a trading point of view on a short-term, day-to-day, hourly basis for Bitcoin at the moment. But the longer term, I remain relatively bullish on crypto going forward, and particularly, obviously, the biggest market cap is on Bitcoin. But don't hold you to in 2026, organize your events in India. I don't know what you mean. Oh, you mean come to India and do some events? Okay, that's interesting. Thank you. Let the guys know on Discord. If you're on our Discord group, IG, let us know. Stick it in here. Your comments, suggestions. There we are. Suggestions box there. Stick it in there, and we'll see what we can do. I'd love to come to India and speak to you all. See you all. So. Anyway, but that's our Discord. Sorry, it's on the wrong screen. If you're on Discord, IG, my friend, stick it. These are all the channels. There's a suggestions box, and stick it there. Or stick it in the general chat, copy it there, so the guys wouldn't see it. But yeah, happy to do something like that. Where was I? Yeah, so crypto technically quite weak currently. Support 80,000 and then 75,000, but don't rule out 65,000. You can see here as we go through 2026. To the upside, we need to breach 100,000. If we do that, it could be quite a rapid rally to all-time highs. That'll be self-feeding. As everybody's been sort of relatively patient here, but you can see how the volumes. It's a really good example of how the candle pattern. The candles don't lie. The volumes, the distance the price is traveling, the body of the candle has diminished quite significantly over the last 5 or 6 weeks, and that is usually a sign of something bigger to come. But don't try and jump ahead of it. The trend is still down. Will 80,000, 85,000 zone hold? If not, we could very quickly move to 75,000 and below. If it does hold, we could inversely, if we move through that 92, 95,000 zone on the shorter term basis, this weekly chart could easily, the price action could take us through 100,000 quite quickly. Okay, that's what 2026 I think holds. Remember the institutional buyers and noise around crypto is just gaining digital. Miss Lagarde talked about it last week from the ECB's point of view. So digital currencies, they are happening. Central bank digital currencies are happening. It's all about timing. It's all about cost. It's all about all those things. Getting obviously places like the ECB is getting other countries, all the countries in tune and moving forward. So, but yeah, I think the future is relatively bright for digital currencies in every portfolio should have something in it of that ilk. It's not going away. Conversely, the oil market, well, anything can happen to the oil market. It's such a geopolitically volatile asset. However, supply currently, as we've been saying for a while, outweighs demand. So we are at, again, it doesn't go back far enough, this setup, unfortunately, but we are at relatively low levels at $55 for WTI, which we've been into in the last couple of weeks. We're currently trading at $58. Big line in the sand is 60, but the market would like to see it above $70. The big suppliers would like to see it over $70, but we're way short of that at the moment. We had an $80 high right at the beginning of this year. And we've been lower ever since, obviously. But the spikes you can see on a daily and weekly basis in oil is very geopolitically based. Obviously, there's all the moves by the United States and other countries around oil. There's lots of chatter that the moves in Venezuela and Nigeria and other parts of the world and Greenland are all fossil fuel derived. Rare earths, metals, and minerals in Greenland derived. So, he's the president is very driven by making US successful and powerful and remaining powerful. And part of that is economic power, and they remain the biggest economy in the world and will be for certainly a long while yet. But China, India, and other nations are catching up very quickly. Both on a numbers of people basis and numbers of graduates and PhD students and all that sort of stuff, and things. The world does change, so we'll see. But Trump is viewing the next 3 years really. And part of his entourage is the oil business and the oil executives. So oil. Week looking into 2026 again, that this downtrend we've seen over the last 2 or 3 years doesn't seem to be getting broken. We may need to remember it wasn't that long ago the futures market went negative on oil, didn't it? Again, that was technical issues in low liquidity times, but anything can happen in the markets. But the fundamentals remain. There is plenty of oil around in the world, so supply is plentiful. Some of the infrastructure could do with upgrading different parts of the world. So there's not a problem with supply. Is the demand there? Obviously, there's the move to away from fossil fuels in many parts of the world. And so oil as an asset can still be broken down for plastics and chemicals and all sorts of other good stuff. But as a fuel, that start again. This happened. We do this at the beginning of every year, the end of every year. The future of oil as a fuel remains obviously quite strong for the next 5 to 6 years. But in the longer term, suppliers and manufacturers, producers need to look at alternative ways of dealing with their raw and assets. So we've seen this diversification from countries like Saudi Arabia away from just the oil industry, Qatar away from just the gas industry. So fossil fuels not going to be around forever, but the demand is still relatively strong for at least, say, the next 5-year window. Things may change in the 2030s. But anyway, as far as next year is concerned, pressure remains, the trend remains to the downside. Is this downslide over? Where is the support? As you can see here, last year we were saying support was around about 67. Similarly, the year before, now it's dropped quite significantly below 60 to 58, 55 zone. So with so much supply still around, things could change. Relationships change. The war, as I said yesterday, trying to bring Russia on board as a business partner more. China on board. China's still a significant oil producer. Lots of people overlook China as an oil producer. Obviously, the Pali bro romance meeting the head of Saudi Arabia, the prince, had with Trump as well in Washington. So again, there's not a problem with supply. So if the economic situations does decline, we could see further declines in the oil market, and that's what looks like the expectations for this second half of 2025 has been. Obviously, things could change. All about the data, the hard data. Really, the key thing for me will be the hard data. Is inflation being as sticky, and is it goods inflation now back in play on the back of the tariffs as far as the US consumers and businesses are concerned? At the moment, the US consumer has been absolutely, say 90% resilient to these tariffs. But it's that sector is what's paying it. It's not. I know the US Trump and the US government are slapping it on the imports, but it's the importing companies that have stomached it. There's been a big build in inventories to front run these big tariffs. The tariffs ultimately aren't as being as bad as it appeared in April. Hence the rise in the asset bubble in equity markets. However, the data might start to bite. That's the big caveat. If the data doesn't start to bite, and I say through the first quarter, if it's not clear that inflation has picked up relatively significantly and it's staying sticky, it's staying higher, the president could be proved to be correct. But then he's talking about handouts on the back of the tariffs that the government have collected. That in itself could generate spending and generate inflation itself. So anyway, it's a big decision, a big market. It's a hugely geopolitically vulnerable market. So the trend remains to the downside. $60 is really the line in the sand for this market to look like it's going to move higher from WTI's point of view. We're getting there at 58. But really, as I say, $70 is a comfortable zone for the major producers, but that's still quite a step away. Okay, so that's my view of oil running into 2026. And again, if we look at different technical setups, again, sort of trend following strategy. This again, 20 weeks, see the volatility that spikes all this, but the trend, you can clearly see, is to the downside, isn't it? And there's that, is that 50? Oh, there's that $60 level on this chart. So there's no big signs of this moving significantly high. And again, the 20-week looked like it was okay, sideways action through the summertime. Then it was down, big down one, sideways action, another big down one, sideways action, big uptick here. It looked like it was over here as we entered into the end of October. But since then, it's been consistent movements to the downside. So still trying to find a floor. Is it going to be at $55? It has been so far, but it may obviously continue to unwind if there's more supply comes on, if there are more worries about demand is increased. Obviously, the flip side of that is, things are starting to pick up and demand might pick up. We could move, as I said before, back to 60 plus for WTI going forward. So let's just go back to our weekly charts from we were looking at yesterday. So weakness certainly in the first quarter, I was expecting in the oil market. As far as the dollar's concerned, the weakness, again, it just doesn't look like it's going to be over any time soon. So the euro yesterday We talked about it hitting 119 this year. We're currently at 117.50, 117.60, 117 for the lot of the year. For the euro was a bit of a pivot area. Once we'd moved higher during the first quarter. So again, the trend much more sideways action with the forex markets, but the volatility, as we saw yesterday, for the dollars increased significantly this year, and so 120 is many upside targets for many of the central banks. Obviously, we've been higher than that. We've been to 125 back in 2021 post COVID, but remember we did smash through parity at the end of 2022 for quite a few months or so, and as low as 95. But euro chatter, as we said yesterday, is for potentially, by the end of the year, a potential rate hike. No changes really expected much during 2026, but it's how they then manage that situation going forward. There are green shoots of growth coming out of Germany and France, but we've still got huge political turmoil, some significant elections as well in 2026. So euros, certainly against the dollar, is looking relatively bid. As we go into the new year, really there's a channel here at 115 and a top around about 118. So there's a 300 pip or 300 point range we've been in for this second half of 2025, and that needs to break if we're going to move higher to the 120 or lower to the 112 range. So that's what I'm looking for or looking at for certainly the first quarter, first half of 2026. But there's plenty of opportunities in that 300 point range, isn't there? And the breaks have to be significant. There's not a lot of data, sort of policy data potentially out of the ECB. Obviously, on the flip across the Atlantic, there's the idea that within weeks we'll have an announcement who is going to be the new Fed. The market's already priced in. They're going to be more dovish than Powell and his crew have been. So there's 2 rate cuts for the Fed going into from May onward. Perhaps before that, one before the new chair, but then the new chair. I mean, he's only one person. I'm saying it's he. It looks like it's going to be a gentleman. But obviously, it colours the discussions sometimes. We've got the minutes actually, haven't we? Is it tonight? I think it is. Yeah, the last Fed minutes are out tonight. Not expecting any surprises from when they get published. So really upside targets for Euro bulls will be 120. But firstly, we need to break away from this 118 area. So 118 needs to be breached and held. The high from 2025 taken out at just shy of 119 and then 120. To the downside, a significant break under 115. Could see it decline as quickly as it rallied in the first quarter of 2025 into 2026. But 112, you can see there's a key resistance level in 23 and 24, and a support level here in 25. So 112 is a significant support level. Before that, as I say, 115, and then the channel break to the upside at over 118, and then they're bringing a test of the 120 zone. Anything above that would be a stretch, but again, don't rule it out. It's not impossible. We went to 124 back in 2021 and end of 2020. So euro, if there's some more talk of or somebody in the ECB themselves talks about rate hikes for the euro area zone. Sterling going into I should have done yen actually, shouldn't I? Let's go to the yen. Much more of a significant story going on there. As I said earlier, I was reading this morning the yields for on and the JGB market in Japan, incredibly volatile. Yeah, this hugely weakening yen continues to dominate discussions in Japan, and they have been quite an interventionist central bank, the Bank of Japan, in the past, to try and encourage growth. It hasn't happened. It's been 30 years since we've seen any significant growth in Japan. And we're at 19. I think it was the most volatile year since 1994 for Japanese yields and the JGB. So particularly that long end, the 30-year, the 50-year, and there's even a 100-year JGB bond that's issued by the central bank. Plenty of uptake for it as well, ironically, but from Abe and through this new prime minister with a big fiscal package, question marks over the impact on inflation's finally raised its head in Japan. It's a head scratcher, isn't it? But again, from a trading point of view, from a currency point of view, from a yen point of view, it remains weak, and discussions within the central bank about intervention at this sort of time of the year, sometimes when there's a bit of thin liquidity, but it hasn't happened. We haven't seen any significant moves or announcements, or they acknowledge that they've done it after the event. But I mean, the only upside from that point of view is we didn't get to 160 this time last year when we were last up here. We did get all down to 140 towards the end of it, but we are now back approaching 160. So is this time, will we get there? So that's certainly an upside target for dollar yen traders. But it could be a step too far to the upside, and we could see some intervention from the Bank of Japan to support the yen, because obviously they're a hugely huge. I was third largest economy in the world as an independent country. We take out the EU, and it obviously massive manufacturer, massive center for intellectual property rights as well in Japan. Obviously, big traditional manufacturers. But some of those traditional manufacturing are big that you see in Japan. The big car manufacturers, big competition from China, and the electrification of vehicles as well. The Japanese traditional car manufacturers not struggling, but they're not leading that market. It's dominated by the Chinese and Tesla to an extent, but certainly companies like Toyota and Honda are doing well, but they're not in the same volume as the Chinese manufacturers. So traditional manufacturing in Japan, like it is everywhere in the world, very much under pressure. So the impact on the yen is continuing to pressure the yen. Again, I can never say never, but 160 does look a step too far, but we could go there very quickly before that, and we could see some intervention. We did get to 162 in 2024. But equally, as I said, we were down at 140, weren't we? But things have changed very significantly since the spring, and the accelerated weakening of the yen because of, and then it's been was happening, and then the new prime minister has pushed it further with her fiscal spending. So we'll see. But 160 is the upside target. Support, it's difficult to call a support on dollar yen because there's different factors pulling on both sides of this pair. But obviously, from a round number point of view, 150 is the next line in the sand. You can see whether I've got my line there as a resistance and support area, a big psychological number as well. That's plenty of potential movement and quite quick movement and strong trends. The unwinding of the yen trade can happen quite quickly as well. So I certainly want to watch. I said this last year about, it could be the currency of the year 2025, the yen. But it's sort of that's sort of correct. But it basically we've gone all the way down and go all the way back to where we were this time last year. So I don't think I meant that, but certainly there's lots of you catch the. You obviously never get the full move of the trend, but it was very strong against the dollar, and now it was very weak against the dollar, and some of the other currencies been even more dramatic, with a bit of a period of consolidation here during the summer. So yen very much in focus again next year, given that the pressure for them to potentially move again with their rate hikes, whereas everyone else is going the opposite direction potentially. There's chatter about Australia and New Zealand having to move as well. But anyway, the yen. Sterling props more cuts from the central bank in the Bank of England. It's had a great year against the dollar. It's more to do with the weakness of the dollar. We went to 138, as we said yesterday. Going into 2026, there are sort of council elections in May politically. The economic data isn't great for the UK. The Prime Minister and his Chancellor is under extreme pressure politically. The programme is, it's not getting the coverage they would have hoped for. The growth isn't happening. The signs, spots here and there, but it's not great here in the UK from a sentiment point of view, certainly, and the hard data isn't great either. Again, more political pressure for the Prime Minister expected next year, but hopefully, from his point of view, hopefully he'll have a better 2026 than he's had 2025. Conversely, it could be worse. It could be a major wipeout in the local elections in May, and he becomes a bit of a lame duck Prime Minister. There could be some surprises from policy. He's not that sort of character. But that really would be needed if he's going to sort of inspire his core, I would guess. But the splits in that as well. But as far as the currency is concerned, sterling. So it's had a good year against most its peers. The stock market has had a very good year playing catch up this year. So again, going into 2026, technically here against the dollar, it remains bid. Again, you can see here 5-6 weeks to the upside. The 135 seems to be a bit of a pivot area. We've gone into this year a high of 138 earlier in the year. So 135, if we hold this area, is positive for the dollar, this cable rate. The recent lows hasn't taken us over under 130. And from a long-term perspective, the 125 area, which sits around about here, a bit further down now, the 125 area has been hugely significant in the past. And as you can see, the last year or two, we've been above that for sterling in particular. So don't rule that out either. Obviously, there's years a long time, but 125 is a key pivot area if the dollar starts to improve. So, but the bias remains to the upside. If we can hold 135 in this first quarter, or even just pivot through it here, a new high as we've seen in the last 3 years for the dollar. 23, 24, 25, as we've gone from 130 to 34 to 38, could take us to 140 in 2026 if this extended wedge, as we've got here, is in play. So 140, not to be ruled out. It's a bit of a stretch. 150 is far too high, I would argue. But again, to the downside, don't rule out a hugely psychological 125 as well to the downside, but 130 first if we give up on 135 to the upside. But again, the outcome is perhaps less cuts from the Bank of England, obviously all dependent on the nature of inflation, which has been particularly sticky, particularly the food inflation in the UK. Some of the housing costs data are starting to roll over and weaken a bit, but food has remained quite costly here in the UK, so that adds to the average bill quite significantly. So sterling, both political and economic pressures on it as we go into 2026. The Aussie or the Canadian dollar, stronger government there. The Carney's not having the same problem. So the loonie is very much on the front foot with the US against the US dollar. But again, huge buyers, as we've seen in the past, at 135, 135.50 it was this year. But 135 is a big zone for the loonie. That's 135. It's just about here, isn't it? Yeah, for the loonie to be a support area. Break of that again, the dollar improves. The loonie improves even more. The dollar CAD going down. The low from last year, 2024, took us to 132.26. So that trend is also in play. However, 140 has also been breached significantly this year. We went to 147.50. So 140 to the upside is first resistance, but and 135 is the downside target as a support zone for 2026, certainly in that first half of the year. See there, 134.80 there on those weekly candles, under 134, but that's a big support zone through there to the downside. Obviously, anything could change. Near neighbours, trading relationships, jobs remain a bit sticky in Canada. It's a bit more volatile. Some of the data recently out of Canada, so watch that one for loonie traders. The Aussie and the Kiwi. Aussie's been one of the better, had a much better year than many. A bit like the Swiss franc against the US dollar. So .70 can't be ruled out, I would argue, for next year. .67 is where we were at currently, and that's been a previous sort of key pivot area. 67, 65. We were rolling through for a lot of the year, and we've been above it for a lot of the year as well. So the Aussie dollar recovered really strongly from a breach under 60 and down into 59 this year on the hiatus of the tariffs. Big trading nation, obviously the impact in lots of exports to China as well. China's fiscal spending stimulus in play, obviously helping the Australian economy. Hot housing market remains in certain pockets of Australia as well. So Aussie dollar benefiting from all that economic activity. Obviously, a big commodity supplier, big gold miners, iron ore. So a lot to offer from the Australian economy. But Aussie dollar moving higher. RBA look like they may be done as far as rates are concerned. But again, never rule anything out. We've had these moves from the RBA. So as far as the Aussie dollar against the US dollar, 67 is key. A breach of that could take us to eyeing 70 again. But again, that looks a bit of a step too far. But again, as you can see here, it's buys to the upside. How long were they going to let the dollar weaken? That's the other thing from the Fed's point of view. This running the economy hot, which they are, but there's going to be a level where it's being clobbered a bit too much. So again, keep your eye out. And 65 is a key pivot area for the Aussie dollar. Kiwi less a strong. It's had quite a bashing when it went under 60. The Kiwi. As we came down this second half of the year, recovered a tad here in these final few weeks of the year, back to 58. But a safer pivot area here, you can see up here at 59 to the 60 zone to the upside if we get back over 59. So 59 would be an upside target for Kiwi. Again, Kiwi a bit like the Australian economy, quite dependent, not as dependent on its exports in China as the Australians are, but it's obviously a smaller economy, smaller population. Inflation running hot, and again, housing markets very hot. Visitor tourists are key to the Kiwi economy as well. Again, big commodity, soft commodity producer, and demand for that is vital from the Chinese and the Asian economies, and they're looking okay around that point of view. So Kiwi's been very volatile this year. 55 was the low, 61 was the high, and we're currently at 58, just about halfway between the two, aren't we? So 59 is where the bulls would like to get us back to for a pivot to 60 again, to the upside. A break of this 58 zone could again certainly move in to test the 55 zone to the downside. But again, there's not a lot of pressure on the. There's not a lot of expectation of big moves from either the RBI or the RBNZ to the downside. In fact, again, potential chart they may be looking to move rates to the upside, hence more pressure for returns from the Kiwi and Australian dollar to the upside. So they're the major currencies. That's my views for 2026. As ever with Forex, is a balance when you're looking at these trades. It's obviously significant. These are all against the dollar, so the dollar's the major player, and then what's going on in these other economies. So ranges certainly for Forex markets, but trends can run as well as with other markets as well. But praise your money, it takes your choice of Forex. The weaker dollar story has accelerated, if you like, into the year end, and it's likely to start off 2026 in a similar vein. Certainly, obviously, with regard to expectations of perhaps more than the 2 cuts that is expected by many for 2026 from the Fed, and then the character that actually takes over the Fed in May from Jay Powell. He will get his feet under the desk, and then the second half of the year policy will perhaps start to become more bullish or not, more bearish or not, we shall see. Stock markets, it's all about earnings, isn't it? Stock markets, and as I say, I've got skin in the game. Currently, money on the table with the Nasdaq, the DAX, and the S&P 500 at the moment. But let's just go back to those. We've had a great run, 20% this year on the Nasdaq, 21.1% last time I looked, 57% rise from this low following the tariff announcement on April the 5th. So nothing's changed, but don't expect these. Remember, over the going back since these markets were created 100 and odd years ago, average annual return is about 8.8%. These 20% plus returns can't go on forever. Full stop. But they have done for a few years, haven't they? I think we're into our 14th year of this bull market, one would argue. So the earnings remain pretty good. Third quarter was better. Fourth quarter will be announced in the next couple of weeks. Second week of January, start getting the fourth quarter earnings, and saying things seem to have been okay. It's all about these the MAGA 7 and the tech stocks as well. As I said yesterday, are we seeing some sort of expansion, widening of the investor base? There's signs of that, and better value outside of the US, but the US is still dragging things. So we could see some significant movements in other markets, as I said yesterday, for 2026. Some emerging markets potentially outperforming. They can't easily do because they're much smaller than the US, but the driver remains the US stock markets, and there's no real signs. If we look at the these signs of this market collapsing, but anything could happen, so don't rule it out. However, I remain biased to the upside. The last leg down on the fib here for the Nasdaq, the fib extension takes to 27,700. If we get back to the new all-time high at 26,240, that's why I remain long the Nasdaq. The DAX, let's just do the US ones first. The S&P 500, obviously 7,000 is a hugely psychological big round number. Many are expecting that in January. The fib extension of this last leg low here takes us to 7,170 short-term target. Short-term target is obviously that key 7,000. We're still 100 points away from that to the upside. Sorry, let me just let me show you my live positions while we've got these on here. So that's sorry, it's the daily, isn't it? So the night of the 22nd, we went long here. Our entry was here. Our stop loss is being dragged right up here now to the upside. So that's still live and that's still in the money at 6,900. Whether we get to 7,000 before the end of the year, i.e. before tomorrow, it doesn't look like that's going to happen, but perhaps we will in January, or perhaps not, just because we got to 6,950 or whatever it was, 6,945 doesn't mean we're going to get to 7,000. We didn't get to 9,550 yet, so perhaps we will start to slip. But anyway, that's my skin in the game on the S&P. The Nasdaq, let's do the Nasdaq as well. There's the Nasdaq back to entry or just above entry now from the 22nd as well to the upside. I haven't got an upside target. I was just going to say I was going to close this out probably before the end of the year, just from an accounting point of view. And on Friday, we'll do how we've done for December and the review of the year. I was going to do it today, but I didn't finish my little spreadsheet. I'll give you a little smidge of this. I started just, manually filling in a spreadsheet from my trading logs. This is the first half of the year, my points, the monthly points, the weeks, the quarters, and the half. So these are the losing weeks: 1, 2, 3, 4 losing weeks in the first half of the year. The rest of them are all winners. Yellow ones are when I was away on holiday or not trading. So generally positive weeks. Remember points, skewed by the indexes, but that's how I'm paid on price per point. So the key thing is that no losing months. That's the key thing. Obviously the odd losing week and many losing days, but that was a bit of a sticky one, a big one there on the 20th of June. We investigated that, what caused that. That was to do with index trades from a numbers point of view, but we still ended up winning for June and positive for the second quarter and positive for the first half of the year, nearly 7,000 points for the first half of 2025. And similar, if better, I think, for the second half, to be honest. But I'll do all this. I'll finish off this for Friday. If you're interested, you want a copy of it, let me know. I'm not hiding anything. It was all posted on our Discord group. If you're new to us, I post. I'll tell you typically what price I've got in and what assets I'm trading and what price I've been filled at. Sometimes if it's late, I just say it's the close of day prices. These are end of day strategies. So, but I do. Well, actually, there we are. These are what's the latest one with an actual price. These are when I'm changing the stop losses all on here. So have a look in the trade chat, and that's where I put them. I'm trying to find one where I've actually put in the actual prices I've got. Perhaps I haven't been as diligent as I was earlier in the year. Perhaps it was. Right, there you go. See when I've changed the stop losses, the points I've lost, points I've gained there. Big 700 points, but it's at 1.47. That's still a good win, 1.44%. No, I do this every week as well. Tends to the numbers and what have you. Because it's probably because it's been Christmas. I haven't been very diligent. Oh, there it is. So there's an example. I normally do them like this: long the asset, the price, my target, my initial stop loss, and typically half of the trade is closed at T1 and the stop loss pulled up to entry. Not always, but that's typically the approach I take. And then, so this was a good example of that. They hit target 1, half the position was closed. Stop loss has moved to entry, and now the stop loss. It hadn't. No, stop loss is raised. I don't know how that finished. That's Swiss. Yeah, I can't remember. But there's another long. Well, the actual numbers. Like I said, Christmas. I've been tired. It's been late. I've just been putting in the positions I've taken rather than actually. No, I don't know how many people follow this or not. But anyway, it's there. These aren't made up numbers, my friends. So, Ivo, there'll be a giveaway. There'll be a giveaway in January next week. Basically, obviously it's holiday time now. People are away, so Ivo's saying here, I just passed my Flex account. Can you give me some tips to create buffer in that account or any risk management tips? Thing about risk management, Ivo, is it's always always get ahead of yourself. That's the first thing you need to think about, whether you're successful trader, new to trading, and been trading for a long time. Always manage the risk. Always think in percentages. Always thinking percentage terms rather than dollar terms. So if you have a winner or you have a losing trade, keep it small. Keep it 0.5% or 1% when you're new. Obviously, the thing about the flex accounts, obviously, they by their very nature, they're a bit risky is the wrong word, but they are designed to be more flexible, so they will have more rules around them. So you need to be more diligent in your risk management, which ultimately will make you a better trader. So don't get sort of lulled into or thinking that just because you're unsuccessful with one type of approach that you could be unsuccessful with other types of accounts. It's all about you improving yourself as well as your trading account. And this idea you're saying you went bearish on gold, well, that was fine, but on these short-term trades, I say 50 minutes short-term, things move around quite quickly. Even if we look at there's a great example. The Nasdaq there. This is the open. It's presumably the opening trades there at 215. Low volatility, low volumes, low liquidity, I should say. But look at this. So this strategy here would be looking to go long at the moment, but it's missed out on all this movement. But so you've got to be careful. These movements can be catastrophic to your account. So keep the key would be the lot size that you're trading with. Keep it small, get confident, get consistent, and then you increase your lot size. Then you can sort of increase your risk a little bit, but keeping the risk management, risk side of your business within comfortable levels for you psychologically as a human being is important, because a lot of people, they say they're going to risk 5% on a trade. But when they look at their account, it's it can be a lot of money. So they get freaked out by the volumes involved. So keep it to 1 or 2% if you can, or less than that, ideally. But anyway, thank you for being here, my friend. I can't remember where I was. Oh, we were looking at the indices, weren't we, of 2020? So we were using this one. Right, I'll wrap this up a bit tight now. I'll wrap this up in the next 10 minutes. So stock markets remain bid. Earnings looks pretty good in the US. I say there may be better returns in other markets, so watch the other, perhaps the emerging markets better. So the FTSE has finally had a really good year this year. As an example, not that that's an emerging market and not that we offer emerging markets, but to trade here. But the dollar markets, the US stock markets still look like not good value, but certainly a positive, a driving up. But things can change very, very quickly. But here, looking at our weekly charts, looking into the year ahead, the next 52 candles still looks relatively positive there. The Nasdaq, the S&P. I don't know why it's done this, but again, the bias is to the upside, isn't it? Some big volatile down candles, down weeks, but they've been bought back as the years progress. So again, looking for all-time highs on the S&P 500 and the Dow, the 30 industrialized companies, a smoother ride as this story of diversification away from the big tech stocks will be there. Eva, I'll be live again to watch the notices on the Discord group. I'll be live again tomorrow for the European Open. I'm away tomorrow. It's New Year's Eve, obviously, and I'm out in the afternoon and obviously out in the evening. So I'm going to do an early one. We're going to trade live the European Open tomorrow. So I'll be here from 7:30 GMT, 7:30 UTC for the European Open at 8 o'clock tomorrow. So if you want to join me then, please free to do so. I tend to trade the DAX and the Dow on the short term opening trades, obviously the FTSE as well. So the FTSE 100, the DAX, and we'll trade with some gold if you want. If you're a gold trader, we'll do that using some of the strategies that I use. So join me tomorrow for that. Okay, absolutely no problem, my friend. That's what I'm here for. Anything I can help you with, please ask. If you want a longer written answer, get to the guys on the Discord group, because they can answer you straight away and it's in writing. Just listening to me blether on, babble on in English. Sorry. So get to the Discord group, get to the general chat, and somebody will answer you, whether it's Christian, Thompson, Katzen. There's lots of guys there to help you. Christian, there's Christians around at the moment, so you've been quite quiet. So ask there that question you asked me earlier about the buffer on and the risk management tips as well. I might give you some more information. So you want to ask that question here on the general chat group. Somebody will get back to you. Okay. All right. Thanks for being here today, my friend. Where's the chart? There's the chart. So yeah, stock markets remain, US stock markets remain bid. People are buying it. It's going up to the upside. The bigger candles are the green candles, but nothing goes up in a straight line. So some key levels, obviously 50,000 here is the next extension here from this last leg down, which is a weak leg actually. So it might be a weak extension target, but 50,000 is certainly in line here on the weekly channel for the Dow. And the most important of all, as we said, the S&P 7,100, 7,000 at first. So that was the Dow. The DAX, less bullish. We had some big support at 24,000. The upside target here takes us to nearly 26,000 on the DAX. And the FTSE, which has been one of the best of the bunch, hasn't had a down leg really. I mean, you could measure that extreme there if we wanted to just be consistent with what we did with the other stock markets for the FTSE, but the trend is very much the upside. 9,935. So 10,000 is the fib extension of this move down, this 2-week move lower we saw at the beginning of November. So we're already back to the all-time highs. We've had new all-time highs this week on the S&P, on the FTSE, and 10,000 would be the next line in the sand. 10,226 is the next technical level on the Fibonacci extension level. But you can see this rallied really strongly from the depths of April. And the FTSE is up 31% from the year low and 20.86% for year to date on the FTSE 100. Okay, so I'm going to wrap this up now. I think I'm done. See you tomorrow, Evo. If you, same time. It's not same time. Sorry. Let's say 7:30. We started with gold. Let's finish with gold. and silver in particular, but remains bid. Big shakeout yesterday and today, but that is a very, very bid market, and the fundamentals remain in place for gold. So potentially another positive year. It's not obviously not as positive as 2025, but who knows? Who knows what the market's going to give us? So hope that was useful. Hope you enjoyed it. Just trade what you see, not what you think. The action is all in the price. The price tells you everything. The price is what is being traded at, and technical analysis just helps you with some patterns and recognition and support and resistance levels in particular. So take care. I'll see you all tomorrow. Be good. Until then, be good. I'll say.